Up until this point, we spent the majority of our time talking about the technical acumen that you need in order for you to be successful as a trader. Now, don't get me wrong, this is a major part of trading, but it's not going to be the biggest part. The biggest part is trading psychology. Tell me if you've heard this one before. Trading psychology is 90-95% of trading. I disagree with that. I actually think that it's probably almost close to 100% of trading. If you don't have a good head on your shoulders and you can't control your quote unquote emotions, then you're not going to be doing very well. It doesn't matter how good your tools are, how good your setup is. It doesn't matter if you spend $50,000 on your quote unquote tools. None of that is going to matter if you do not have and you do not develop the craftsmanship in order for you to read the tools and be complacent in your own emotions, especially when you're taking some positions. So in the next couple of videos, I'm going to be talking about a couple tools that quote unquote will help us a little bit more on the psychological side on whether we want to take a trade or not in the first place, and whether we hold on to that trade. Most of you are going to be discretionary traders. Not a lot of you are doing automation, but if you're doing this at a discretionary capacity, a lot of the tools that I'm going to share with you, they're no magic pills. There's no free lunch in the market. It doesn't exist, but they will help you psychologically, and they definitely help me psychologically. More so using the higher time frames. Hopefully that was very clear when I was talking to you guys about technical analysis. I mentioned the higher time frames quite a bit, and we're not going to change that. I'm just going to focus a little bit more on the psychological side, and I'm going to share with you some pretty cool tools that help me put a little bit of a notch and a little bit of a relaxer on my psychological state, especially when I'm looking to take some trades. So with that being said, let's dive into a couple of indicators here and talk a little bit more about psychology. Hey guys, welcome to the 15-minute time frame here on QQQ. Today I'm going to be talking about the Fib Retracements and how this relates overall to our psychology and just getting good prices in the market. If you've never heard of the Fib Retracements, there's plenty of good videos that are breaking down the mathematical relationship and concepts behind them. I don't want to do that here today. I want to focus more on the practical side of this. So in practical terms, we're going to be talking about how to anchor the Fib retracement and how to use them after you anchor them, right? So we're just going to spend a couple minutes and I'm going to give you several examples of how I've used this recently for making some pretty major decisions in my trading journey overall. So I like using 10, 15, 30, 1 hour time frame. The reason why, just at a molecular level, when we're talking specifically about, the molecules that exist on the 1 minute, 2 minute, 3 minute time frame, there's a lot of movement going on. There's a lot of activity. Can you use the concepts that I'm going to share with you in this video on those shorter time frames? Yeah, go ahead, knock yourself out. But it has more success the higher time frame you go, especially when you're going above the 30-minute time frame. And I'm going to show you a couple examples of where this has worked for me recently when you're looking to buy the dip, quote unquote, right? So let's go back here to the 15-minute time frame. That's just my little warning for not using the shorter time frames. I'm looking for peaks and troughs. So the Fib retracements are not going to be a predictive model, right? It's very difficult to be predictive, but you can be detective, right? Detection is all what traders do. A statistical modeling, probabilistic modeling, and also being detective. When I'm going to use my retracement tool, depending on what platform you're using, it's going to be all the way here to the left-hand side, right? So Fib retracement. When I'm anchoring the fibs, I'm not putting it any place on the chart, right? Because what am I anchoring to? Like what kind of story am I trying to tell here with the fibs? Notice that there's a whole bunch of percentages here, and there's also these numbers here that are off to the side. They might seem a little bit funky, but I want you to pay attention to 3 specific numbers, and we'll talk in depth about them here in just a second. The anchoring part of the Fib retracements is the most important thing. You always want to anchor it at the lowest, most previous point. Or if you're looking for maybe after some exhaustion or after some buying, you're looking to short a position, you want to do the exact opposite of what I'm going to explain here for a long position. So let's remove this real quick. And let's go back to the Fib retracement. So remember what I just said. The most recent lowest point where your eyeball very, very clearly can tell what that lowest point was. If that low point, for example, let's just say we start retracing this all the way and then we break that support area or that demand area, then you're going to go to the next lowest point. That's how the Fib retracements are going to work. So here it looks like we have a nice little rally. You can draw a trend line. All that stuff we can see is pretty clear. The lowest most point, this is also just a very, very little detail, but it's an important detail. Don't go from the body of the candle, but actually go to where the wick is. You want to go to the lowest most point on the wick and then use that as your anchor. Now, the topmost point needs to be the same thing. You're not going to go to the body of the candle. I know that this is small on your chart, but you don't want to go to the body. You want to go all the way to where the wick is. Cool. Very important because those wicks also represent where we had a struggle between buyers and sellers. So they have to be represented on the chart as well. So the 3 points that you need to be paying attention to are going to be the 50% retracement, the 61.8% retracement, and the 78.6% retracement. What are you looking for? What are you thinking about as a trader? Most of you are going to be like, you know, I want to get a good price in the market. Hopefully you are, right? If you're an investor, if you're looking for your swing trades, you want to get a good price. You don't want to buy at all-time highs, right? It's probably not the best time to buy because things are overvalued in the market, right? If you listen to anyone that knows anything about the stock market, they're generally not buying at all-time highs. They're waiting for the market to pull back, right? Anyone will tell you that has any experience. The Fib retracement tools are going to help you with that, exactly that. If you use this in tandem with a VWAP, a good, finely tuned VWAP, man, this is a recipe for just absolutely brilliant trading. Honestly, it really, really is a recipe for brilliant trading. So I'm going to throw the moving averages on here. I'm going to use a stack that I like to use, 5 and 21. If I'm looking at this, I don't know where the highest most point is going to be. That's not the point of using the Fib retracements. The point is to look at where the demand levels could potentially be. The 3 most important levels, I'm going to repeat this one more time, are going to be the 50% retracement. So that's my box, my demand area. The 61.8% retracement. So let's draw another box here, a hollow box, but nonetheless, it's a box. And then the other area is going to be back down here. So where do you think I'm setting my alerts if I'm doing intraday trading or if I'm doing intra-week trading? Probably going to be setting it at these areas. So if we start pulling back down into these areas, these are potential areas of interest. Now, alone by themselves, right, by themselves, I can't make a decision if I'm just reading the tea leaves, if I'm just looking at the candles and saying, well, Sage is telling me it's 61.8, buy 10,000 futures contracts. No. I'm not saying that. I'm saying that these are areas of interest that you are going to use as an extremely high quality value confluence. You use this and you're like, well, this is a value area, man. Just like the VWAP, right? You're trading below the VWAP and you're looking for that value area, right? That's how that works. If you're throwing on a VWAP indicator here as well, you have 2 areas of extremely, extremely high quality confluences for you to determine whether you want to take a position or not. So are you going to be maybe shorting this position? I probably would not look to do that here. I'm going to be waiting for us to trade back down to either of the 3 areas. Now, what happens if we have a full retracement all the way back down to that 100% mark, right? All the way back down here. Remember what I said just a couple minutes ago. You want to use the last most aggressive change of direction. So I'm going to be anchoring this point instead of here. I'm going to be anchoring it there. You want a huge amount of volume. You can use auto-weighted fibs as well. There are indicators that do that, but I still prefer to do it based off of my discretion, right? So that's a point, and that most definitely is a point. So as we start breaking lower, because you know that can definitely happen here off the 15-minute time frame for sure. Those are the points that you want to use. So what's the game plan, right? What's the practicality of using all of these things that I'm teaching you? Let's draw the fibs here one more time. Let's use the fib. Let's throw that on. The practical example, or the practicality of using this particular tool is when you're trading back down into these areas, throw on whatever triggering mechanism that you use. If you want to use the moving averages, I'm not specifically using the moving averages per se now. I'm using something a little bit different that we'll talk about in subsequent videos. But this is fine. This is perfectly fine. I'm going to give you 3 examples of where I recently used this, just using the moving averages, right? We don't have to overcomplicate it. As soon as we start trading in those pockets, then I can look to make a decision based off some confluence factors. So now let's actually talk about where I've used this recently. I've used this on Apple right here on the 4-hour time frame. I bought some positions on Apple. So my anchoring is off. Let me just move that anchor here. Cool. Why didn't I anchor it at the top of the wick right there? Well, this is looking back in time. My anchoring needs to be where I last saw a peak, right? So that peak that I saw on Apple was all the way here for earnings. So looking back in time, you're going to say, well, you kind of just explained for me that the anchoring point needs to be at the top of the wick. I bought this before this rally. Why do you think I bought this before this rally? Let me explain this. Let me just blow this up just a little tiny bit. So I'm looking and then I put a bottom all the way here. Let me just adjust that. Let me stick true to my educational process here. So we bounced off here and then we had just an incredible rally going into earnings, but that rally was faded. So that rally faded and then we pulled back, not once, but twice, right? We pulled back twice. Did I catch Apple for the first time when we reversed here? No, I didn't do that. I definitely didn't do that. I have to do that on the shorter time frames. But when I was looking to quote unquote buy the dip on the 4-hour time frame, the 3 areas that I wanted to pay attention to were going to be the 50% area. I wanted also to pay attention here to the 61.8% area. And then I also wanted to pay attention to this area right here. So in context, imagine that this right here didn't exist. I can use the replay feature. Let's go back, right? Let's just imagine that that doesn't exist. So I didn't know, but I was waiting for these 3 areas. I was waiting for these 3 areas to quote unquote find a value area. I did use other indicators as well. I just mentioned one of them that I think is very good, the VWAP. I'm waiting for those areas. And then finally, when I'm getting my 5, 21, 9, 13, whatever stack that you want to use, that's where I decided to pull the trigger on the particular trade. So we'll play this forward. And this is an actual trade that I signaled to swing. So you'll see it'll come back down into this area, and then I had my confluence factors, and then from there I decided to pull the trigger on the trade. I specifically took the leverage shares position on this, so right now I'm sitting quite nice on the Apple position. It could be a little bit better. Yeah, it could be a little bit better, but boom. Had a nice bounce, nice engulfing, and then you have a cross specifically around 195. I caught this earlier. I caught this at 191. And then the rest is history. Now, how are you going to use the fibs in order for you to decide your risk reward and also where to set your stop losses? That probably is your natural inclination here to ask. Let's throw on the fibs here one more time. Let's make sure that we get this pretty. My anchoring point was all the way up here. If you're going to be using the risk reward principle, it's not hard. It's really, really not hard. Take your risk reward calculator, which all of you should be using for sure. Let's say I take this position, let's say exactly where I took it at. I took it at 191. So 191 is right there. I can use the fibs in order for me to decide if the trade is worth the risk reward. So let's anchor that there and let's anchor that there. That's a 2-to-1, dude. That's a 2-to-1. So your stop loss is going to be right at that fib level. That's perfectly fine. If you want to go tighter, I'm not against that either. I did go tighter. I don't want to wait until we get back down to 61.8. I don't want to give it that leeway. If I'm wrong, I'll be wrong small. And if we pull back to 61.8, that's fine. I can jump back into that position so long as that there's 2 or 3 other confluence factors. No problem. What if we pull back all the way back down to 78.6? Well, I took a very small loss here, and my risk reward is 4 to 1. Now, I'm still holding on to the position. I'm not going to just hold on to my stop loss exactly where it is here. I'm going to be moving that up. So right now, this trade is literally a free trade for me. It literally is a free trade. And you can use the fib points, the anchoring points, as suggestions of where your profit target can be and also where your stop loss can be. It's as simple as that. I'm going to give you 2 other examples. I recently took a large position on Amazon. I signaled this in our Discord group. The Amazon position was not hard for me to decide either. Right? So let's anchor this at the right place. Let's take that, anchor it at the bottom of the wick. And then I saw this huge explosion to the upside. So that would be the next anchor. And then I'm looking for these areas to trade back into. In this specific example, I'm using the 5 and the 21, which is the EMA stack that I prefer. That's my anchoring of choice. It looks like we pulled back all the way back down to 78.6. Cool. How did I know that we were going to bounce off that level? I have no clue, dude. I have absolutely no clue, but I'm using my moving averages. So I know, is the trend still to the downside or to the upside? So I took this trade around 171.25, I believe is what I took it at. I took leverage shares on this. I got a really, really good price, a really, really good price. And right now I'm up like $3, $4 on the position. Do I think it can go higher? Of course I think it can go higher. Look at the daily time frame. I'm waiting for this to go back to all-time highs sometime here in the future. Now let's go back here to the 4-hour time frame, which is what I use to take this. The Fib retracement tool is not, it's not magic. It's not magic. They're just overall positions, demand levels for you to decide and monitor whether you want to take a position or not. You're not going to take it just because it hits the 78.6 level. Some of you might be doing that. Some of you already might have a trend tool, or you might have a trading mechanism that identifies the trend turn a little bit quicker, and that's fine. And we're going to be talking about that in some subsequent videos. That's totally fine to do that. But just using this, just using the moving averages and using the retracement levels already is an extremely powerful recipe for you not to overpay on something and also catch a little bit of wind in your sails. The last example that I'll give you is SOXL. These are all trades that I took. They're all recent trades that I took. On SOXL, I did exactly the same thing, literally identical to the T. Let's use the fibs. Let's go to the bottommost point right here. Let's go to the topmost point. So where do you think I took this trade? take a wild guess. Take a wild guess, right? I took it very close to the 61.8 area. I have my EMAs that are stacking, and this is just a really, really simple example for beginner traders. We use a little bit more, I would say a little bit more sophisticated computations now, which again, I've said this for the third time, that I'm going to share with you in subsequent videos. But all in all, you can see that I'm still using the fibs. Let's anchor this just a little bit better. I'm a little bit of a perfectionist when it comes to anchoring the fibs, so I want to make sure that it's absolutely perfect because I want to get the most precise calculations. So cool. We hit 78.6. Now you might be thinking, well, it didn't hit that level exactly. Nothing hits anything exactly in the market, nothing. But you have a really, really good sense of where the wind is riding, right? That's what you want as a trader. You want as much edge as possible. You want 2 points here, 3 points there, 4 points there, and you want to marry all the different confluences and all the different trading tools that you're using in order for you to make concise decisions. Hopefully, I've been able to prove that to you here just using a simple, practical example of using the Fib retracement tools. I happen to have taken this around $9.50, which is exactly lining up where you see the confluence, right? Ain't that difficult. Hopefully, with this short Fib retracement tool, I obviously cannot go over every single example or every single calculation that exists mathematically, all the relationships that we have here, right? Because I wanted to keep this practical, but hopefully just using the concepts and opening up your mind into using a different tool, maybe that you weren't accustomed to, you can already understand that this is a little bit more strategic and helps you more on the psychological side than just using moving averages alone or just using discretionary trading at 100% your capacity. Use the tools, right? They're there and they work extremely well.